Hey traders, today we are going to be talking about the RSI. The RSI stands for Relative Strength Index and is an indicator that was developed by J. Wells Wilder. Wilder had developed this indicator to oscillate between 0 and 100 with three main levels that we're going to be looking at. These levels are defaulted at 30, 50, and 70, with 50 being our main focal point for the indicator. Anything above that 50 line is showing a more bought than sold market and a more bullish momentum that we will be trading off of. Anything below that 50 level is going to be showing us that we are more sold than bought and displaying that more bearish momentum in the market. Now the other two price levels, 30 and 70, will just add further differentiation to that more bought and that more sold level. For the 70, anything between 50 and 70 is more bought than we are sold. However, once we exceed 70 and go between 70 and 100, we are now in an overbought market. When we're in an overbought market, we can expect a reversal to the bearish direction to start to display itself somewhat soon, as markets don't like to remain overbought for long. We have the similar instance on the bearish side when we are below the 30. As we're below 30, between 0 and 30, we're in a much oversold market. We've had an extreme amount of bearish momentum, and pretty soon we should be expecting to see a reversal happen to go to the more bullish side for the price action to get closer to that 50 level and be at that sort of stasis until its next movement. Our second entry, which we'll discuss, and a much more common entry for the RSI, will be our recoveries from these oversold and overbought ranges on the market. As we're below that 30 level, we're in our oversold range. The market doesn't like to remain oversold for prolonged periods of time, so we'll see a reversal in the price action as the RSI starts to go from below to above that 30 level. Once we start to get that turn towards the 50, or even potentially just waiting till we get that crossover on the 30 line as a whole, this will be our buy entry as we're trying to catch that momentum that the market is using to recover from that massive price action drop. Very similar instance for when we are above the 70. We just had a massive rise in price, a huge bullish push in the market, and now the market wants to recover, not remaining overbought for too long, wants to go back down towards that 50 level. So once we see that curve towards the bearish direction while we're above the 70, we're waiting till we cross that 70 line as a whole to be a little bit safer on our entry. We'll go ahead and enter our sell and catch that push of bearish movement as we recover from our overbought market. The third and final entry we'll discuss on our RSI is probably the least common, and most traders probably haven't even seen this used, mainly for the fact of how risky it is in its utilization. This entry will be based off of crossing above 70 or below 30 on our RSI. To bring this into a real-life example, think about moving a really heavy dresser. We're pushing and exerting a lot of force on this dresser trying to get it to move, but it's just not going anywhere. As we're pushing and pushing, we finally get it to move and we get that really quick jerk in the motion of the dresser, and we have to lessen how strong we're pushing it to maintain that constant velocity. It's the same thing with the markets. The markets are driving up with a good amount of strength towards that 70 level. If it breaks that 70 level though, all of that strength that it was using to try to get to the 70 becomes a lot easier to push the market quicker at that point. So once we cross above 70, we get that jolt in the motion of the market. Same thing for crossing below the 30. We're pushing the market into that bearish direction, hit the 30, cross over, and we get that rapid jolt in the market movement on that bearish side. This is the riskiest method because a lot of times you'll notice that those charts will just very quickly spike into overbought and then recover, or spike oversold and recover. And if you're not watching carefully and you don't have your take profits and stop losses accurately placed for the type of trade that you're utilizing, you can see that you'll lose a lot more money than you were even attempting to gain at times. So if you do use this method, it's recommended to have your take profits a little bit closer and have tight stop losses to make sure you don't fall victim to that spike. Don't hit that take profit and then hit your stop loss. Wilder's RSI has become one of the most commonly used oscillators in the trading world, just for the fact that it shows you so much information all in one simple line graph. Hopefully this has helped you be able to utilize the RSI in your day-to-day trading and see the benefits that Wilder had opened up for the trading world. If If you liked this video, feel free to click on the subscribe button below. That way you can get more notifications when we put out videos like this to help explain certain indicators and strategies to you. And also feel free to put in the comment section different indicators or strategies you'd like to see talked about, and that way we can also explain those and put those videos out to help traders understand those concepts a little bit better. Thank you all for joining us, and happy trading.